Hello and welcome to the investment review for October 2013, looking back at the events of last month and how these events could have affected our investments. I will begin the review with some market commentary. At the time of writing, the US government shutdown is unresolved, and the standoff between the Democrats and Republicans over failure to agree the budget still continues. Hopefully common sense will soon prevail. But what is of greater concern is the approaching 17th of October deadline when the US government reaches the current debt ceiling, the limit at which it can borrow money to pay its bills. In order to continue to meet its obligations and to avoid defaulting, this must be increased and needs to be agreed by Congress. In last month's report, we commented on the possible effects of the anticipated withdrawal of monetary stimulus by the US Federal Reserve. A decision was made by the Federal Reserve to try not to reduce monetary stimulus in such a way that would potentially hurt the economy. It has therefore decided not to start tapering their bond purchase program this month, as had widely been expected. The unemployment rate has now reached 7.3% and is therefore close to the 7% set as the point at which the Fed could begin reducing its stimulus. However, it plans to continue to maintain its current level of bond purchases until economic conditions improve. As markets react to news, the Fed needs to be careful to manage future information about its policies to avoid damaging investor confidence. It is widely hoped that the current problems in the US will be quickly resolved and that economic recovery will continue, because, as the world's largest economy, whether the news there is good or bad, the ripple effect is felt worldwide. Turning our attention to Syria, in last month's investment review, we deferred making any comment about Syria as there was a great deal of uncertainty about what could actually happen. The immediate threat of military intervention in Syria now seems to have been forestalled by diplomacy, but is nevertheless a continuing threat dependent on the Assad regime living up to its obligations under the agreement to provide a report of its chemical weapons and to destroy or remove them by mid-2014. Oil prices have been affected by events in Syria. Although Syria does not export significant amounts of oil, its closeness to major oil-producing nations such as Iraq and Saudi Arabia, and its proximity to the Suez Canal, meant that military action against Syria had the potential of a knock-on effect on oil production and transport operations throughout the Middle East. The risk of this potential disruption pushed up oil prices. Of course, the threat of US military action still exists, and as the risk in the Middle East has been dampened for the time being by the agreement with Assad, this is being reflected in oil prices. The cost and availability of transport fuels, which account for 80% of all oil usage, affects all of us. Transport fuels such as gasoline, diesel, jet kerosene, ship bunker fuel, link all elements of the economy, so the higher the oil price, the more costs increase, thus slowing global economic growth. No review would be complete without a graph, and this time we've included a graph which demonstrates the fluctuation of oil prices since 2000. Just to pass some comment now on the long-awaited UK recovery. Recent data from the ONS shows the UK recovery had gained momentum in the second quarter, with further growth expected in the third quarter, and forward indications that the economy should also perform well in the final quarter of the year. Total economic growth in the UK for 2013 could therefore be higher than previously predicted at an estimated 1.7%, and as one of our main trading partners, the Eurozone, recovers from recession, this should help boost exports and add to the sustainability of the upturn in the UK. Current political tensions in Italy are a risk to the Italian economy, and its government needs not to collapse now, but instead to be allowed to follow through reforms to address its recession, its high debt, and obviously its unemployment issues. Further afield, and giving consideration to Japan, in August their consumer price index rose again, this being the fifth time in the past 6 months, which is an indication that the government's policies to end 20 years of deflation are succeeding. In the investment review that we published in February, we gave warning of a new tax charge that would be applying to some families, And just to remind you, the new high income child benefit tax charge for 2012-13 will apply to anyone who has individual income over £50,000 and they or their partner received child benefit after the 7th of January 2013. People who could be affected by this can register online for their tax assessment for the first time, and a short form can be completed online by following the link in this presentation. And failure to register could even, in some circumstances, result in a fine. Over 1 million families are potentially within the grasp of this new tax, and while it's too late to mitigate the tax charge itself for 2012-13, there are ways that this can be achieved for the current tax year with careful tax planning. We're happy to help if you wish to discuss your options. So bringing this month's review to summary, every month there's something new to report that can have an immediate effect on the value of all of our investments. As news continues to arrive, we strive to remain focused on the needs of all of our clients in ensuring that we make the right decisions about when and how to react to events around us. Overall, cash is still providing poor returns, and in order to attempt to beat inflation, it is now necessary to take on board some risk. Our portfolios are, of course, regularly reviewed and carefully tailored to the needs of our investors to ensure they include a level of risk that is suited to their individual capacity and tolerance. As always, if you should have any concerns at all, please feel free to contact us. The last slide of the review has all of our contact details. Thank you for listening.